What edition is your textbook in?
I've had two different textbooks, so
Okay.
actually looking to create a new version of it
Okay.
next year.
Okay. Nice. Very cool. Okay. So maybe you'll jump into the story that inspires this question. What do investors need to understand about correlation versus causation when they're analyzing stock price movements?
Yeah, this is a really classic. It's one of my favorite stories. It's the first chapter in the book called "Did Ronaldo Move the Stock Market?" And
Yeah.
this is one of the most contemporary stories that I include in the book. It's set at a press conference in 2021. You might remember it, or some of your viewers might remember it, at this European Championship soccer championship. At a mandatory press conference, Ronaldo sits down. Prominently displayed were two bottles of Coke, since Coca-Cola was a major sponsor. He took the two bottles, immediately moved them out of camera sight, grabbed a bottle of water and said, "Aqua, water, no Coca-Cola." And on that same day, and this was a big story in the Washington Post and elsewhere. The Washington Post headline said, "Cristiano Ronaldo snubbed Coca-Cola. The company's market value fell by $4 billion." And so if you look at Ronaldo, and we think of him as an influencer. In fact, he's number one on Instagram in terms of the hundreds of millions of followers that he has. So it seems like a clear case of cause and effect. Moving the bottles, and it cost Coca-Cola $4 billion. Turns out that's not the real story, and that's where we get into causation versus correlation. Was there correlation? Absolutely. The same day that Ronaldo was at this press conference snubbing Coca-Cola, the Coca-Cola stock value overall fell by $4 billion. But there's a technical explanation for it, and it's a common explanation of any stock that pays dividends. It's what's known as the ex-dividend day. When a company pays usually quarterly dividends, they'll announce that in 2 weeks we are going to be distributing this dividend, and in 2 days, if you still own the stock on that day, you will get the dividend. If you buy the stock a day later, you will not. And so what do we expect to happen on the so-called ex-dividend date, where you're not entitled to the dividends? We would expect the stock price to drop roughly by the value of the dividend. And coincidentally, that's what was happening on that particular day. In fact, the major drop in Coca-Cola stock price came, as we would expect, right at the opening price. And this was just before, it turned out coincidentally minutes before Ronaldo started his press conference. And in fact, what happened to Coca-Cola the rest of the day? It went up. So we
Wow.
could have had a whole different scenario, a different take. So it's an important story that correlation and causation. Correlation does not imply causation. I tell another story, if I may, to really drive home the point. And it has to do with what's known as the Super Bowl effect. Super Bowl started, I think it was around 1967. The champion of what was then the NFL versus the AFL. Now they're the National Football Conference and the American Football Conference. What was observed after about 10, 20 years was that there was this major tendency that if an NFL team won the Super Bowl, that year the stock market did really well. And if an AFL team won the Super Bowl, stocks tended to be down. And it was pretty dramatic. And in fact, in 1990, based on 22 years of data, in 20 of those 22 years, the Super Bowl effect worked brilliantly. And there was a famous study that was written up in the prestigious Journal of Finance. So that got a lot of attention. What do you think has happened since 1990? Well, just as we would expect, it's been a coin toss whether an NFC or an AFC team wins. There's no predictive ability, and there's no. I've asked students this, and I haven't come up with any convincing answer. how could it possibly cause the stock market to go up or to go down? And so that's really the story. You need to be careful and consider
Yeah.
what the causation might be.
So the football factor performs poorly out of sample.
That's correct. Exactly. It's all about out of sample, which reminds me of another saying. I've never seen a back test that I didn't like.
Yeah,
Back
that's
tests
right.
look great.
Yeah.
Can you talk about how we talked earlier about Fama and French's factor models, and I alluded to the fact that there are a lot of different factor models and hundreds of factors. How does this correlation versus causation thinking apply to the concept of factor investing?
Yeah, so it really is quite important because this whole notion of factor investing means that the whole premise is that, and in theory, this makes sense. Stocks are driven by individual stock returns are driven by a number of factors. Back to the original factor model is really Bill Sharp's capital asset pricing model, in which there is just one factor, and that's the market then will drive or cause individual stock prices to a greater or lesser extent, depending on this beta risk measure. Now, Fama French and others have come along to suggest that there could be more factors, and a lot of potential factors have been identified: dividend to price ratios, unexpected earnings, leverage, price momentum, volatility, all kinds
Yep.
of things. In fact, famously, John Cochrane described these as the factor zoo. There are literally hundreds of potential factors out there. But the important thing to keep in mind, this goes back to correlation versus causation. For a factor model to truly work, there has to be some causation. And yet through backtesting, we can identify correlations, but it's really tough. We've got to make a convincing case that there is some kind of causation. So we have to just be really on the lookout for what might be so-called spurious correlations.
What are some examples of masterly inactivity?
So this is based on a chapter of my new book, Trailblazers, Heroes and Crooks. Masterly inactivity basically is the art of doing nothing. And so I give some examples before switching into an investing world. Going back to 200 BCE, we all have heard stories of the famous military master, Carthaginian Hannibal Barca, one of the greatest military commanders in history. And there's this image of him going through the Alps with his army of elephants and wreaking havoc as he moves through the Roman Empire. Quintius Fabius had the unenviable task of being appointed Roman dictator and having to try to stop Hannibal. And so what he did was he got an army together, and he set a camp up fairly near where Hannibal was. And when Hannibal found out about this, he was all itching for a fight and came out and said, "Okay, let's fight." And Fabius did nothing, didn't engage, and just bided his time. And the reason he was doing that is because he didn't feel the timing was right. And so he wanted to bide his time and basically do nothing, wait until he could get some reinforcements and be in a much stronger position. And it really paid off, and he had this huge military upset. And so this is where the term masterly activity or a Fabius victory was really started. In the sports realm, 1974, great example of masterly activity in Zaire, Africa, now known as the Democratic Republic of the Congo. Probably the greatest boxer of all time, most famous, Muhammad Ali, who at this time was in his 30s. Had been the world championship, but was a conscientious objector in the Vietnam War, and so refused to serve, and so was stripped of his title. He eventually worked his way back into the ring, and he was coming up against this world champion George Foreman, who many of your viewers and listeners might identify with the George Foreman grill, where he made more money after his boxing days. But he was a stronger fighter. He had a longer reach. In terms of some odds makers, Ali was a 40-1 long shot with this particular fight, which became known as the Rumble in the Jungle.
Yep.
Well, what was Ali's strategy? It was really masterly activity. Became known as rope-a-dope. And Ali, throughout most of the fight, just protected himself, went against the ropes, let the ropes absorb some of the punches until after about 6-7 rounds, Foreman had tired himself out, and that's where Ali came back and had this huge upset knockout. So classic masterly activity. As it pertains to investing, we come back to Jack Bogle, who founded the Vanguard Group in 1975. And really this introduction of the first mutual fund index fund is a great example of masterly activity. If I buy and hold an index fund, then I don't have to do anything else. And Bogle had a famous saying, if your broker calls up and tells you need to do something, just reply, don't just do something, stand there, was his
Right.
famous thing.
Such an important lesson for investors. It's like one of few fields. Well, you gave a couple examples there, I guess, that are not investing related, but there aren't many things where you can do less and have a better outcome. But investing, it's like it's if you try and do more, you probably have a worse outcome.
Absolutely.
Yeah. What were the big lessons for investors from Madoff's massive Ponzi scheme?
Yeah. So Bernie Madoff, at the time that this was happening, Bernie Madoff was actually a very well-respected professional in the industry. He had come up with some. He was really a technology innovator, and it also appeared that he had a really successful side gig, and this side gig appeared to be a hedge fund that was purportedly able to provide these double-digit annual returns with almost no risk. Well, of course, as we know, as we found out later, it was just a huge Ponzi scheme, the biggest Ponzi scheme in the world, and it had gone on for decades, and investors lost billions of dollars. So a lot of important lessons come out of this. First of all, we want to be skeptical if anyone brings you a low risk, high return investment promise, because usually higher expected return comes with higher risk. And of course, it's the classic, if something appears too good to be true, it probably is too good to be true, especially if it purports to show a really high Sharpe ratio, going back to the Bill Sharpe metric. Other messages, you want to look for red flags in terms of investment advisors who overstate their credentials, which in retrospect is something that Madoff did, as well as lacking transparency. Due diligence, I think, for any investor is really important. And I love Ronald Reagan's favorite Russian proverb that he used with Mikhail Gorbachev, trust but verify. And it's really important to, it's good to be trusting and invest with somebody we trust, but you really want to make sure that they're above board. I think another takeaway is that when we think about risk is more than just volatility. And so the risk of fraud is something that's really important as well.
How old is the art of FOMO, investing into hot assets?
Yeah, so FOMO, fear of missing out. We have documented evidence that it goes back at least 3 centuries, and it goes back to a well-known individual, Sir Isaac Newton, esteemed mathematician, physicist. He was an apparently astute investor, because after he retired from his academic position at Cambridge, he became the master of the Royal Mint. And so he knew a thing or two about investing. However, in 1720, he succumbed to a really bad case of FOMO. It involved the South Sea stock, and there's a whole story to be told, but we'll leave that aside in terms of the South Sea stock. But what happened in 1720 is that South Sea stock went from in January around 100 pounds per share up to 1,000 pounds per share by the summer, and then crashed back down to 100 by the end of the year. And
Wow.
what happened with Newton? He was invested in South Sea stock. He watched the price go up, and he decided to sell, and he made the equivalent of what would have been millions of dollars. After he sold, he watched as the stock price went up more and more and more. And this is where he got this FOMO. So he
Oh
went
no.
back in the market, and not only what he had sold, but even he went, it was like he pushed all the chips all on red, and he went all in, and it was probably at the worst time,
Oh,
and he lost a fortune. And purportedly he came up with this famous saying that I can calculate the motions of heavenly bodies, but not the madness of people.
what's the science behind FOMO?
So FOMO has been studied for a long time. There's a research paper that goes back to 2013, and they had an interesting definition of FOMO. They called it a pervasive apprehension that others might be having rewarding experiences from which one is absent. And their context, I think, rings true today, was in a social media context. And what they found is they conducted surveys and found that by their particular measure of FOMO, those that had high FOMO scores tended to have high levels of social engagement, but these individuals were less satisfied. So it's one who is engaged in something, but it's not giving you that satisfaction, and you're always looking out for what you might be missing out on.
How do you think investors can avoid losing money on FOMO bets?
So this is where I think we have to be aware of our emotions when it's time for us to make investment decisions. I think the best thing that you can do once you've sold a security, don't ever look at it again. And that's one way to avoid
Hmm.
FOMO. Don't try to time the market. Timing the market is very difficult. Be disciplined, have some kind of well thought out plan, and then stick to that plan. Dollar cost averaging is a great strategy where each month or on a regular basis you invest a certain amount of money. And certainly in this day and age of social media, really try to avoid peer pressure or somebody's claim that there's a really hot tip.
Yep, those are all good tips. Now, speaking of FOMO, a lot of people FOMO'd into SPACs a few years ago now. What
Yeah.
lessons from history would have suggested, if people had read the history, that SPACs may not have been the wisest investments?
So I have an interesting story that ties into this whole notion of SPACs. So SPACs, first of all, are special purpose acquisition companies. They're also known as blank check companies. And the way they work is you invest a certain amount of money, and there's someone who's promoting this particular fund, and they say, okay, give me your money, and usually it's within the next 2 years, I'm going to invest it in something, and this something is going to be really good. Just trust me on this. It's going to be really, really good. The story tell in the book, Trailblazers, Heroes, and Crooks, is set in 1720, and I call this sort of the and it's partly tongue in cheek, the original SPAC, because it has some parallels with the original blank check company. And this was right around the time of the South Sea Company, where its stock was skyrocketing. New companies were coming to market. They later became known as bubble companies. There was a crook, we don't know his name and lost to history, a promoter from Cornhill. And his claim was that he had a company for carrying on an undertaking of great advantage, but he wouldn't reveal what the nature of the business was, not for another month. And in another month, he was going to reveal it. So he set up shop one day, and it really sounds like these blank check companies. Set up shop, took in again the equivalent of probably $1 million. That night he closed up. He went to the continent and was never heard from again. And so that's I think it obviously didn't end well. I think it's a cautionary tale. Obviously, with today's SPACs, something like that extreme wouldn't happen. But even if there isn't a good investment, or if it's even only a mediocre investment, you've got this 2 year period where you've got a real opportunity cost of your money just sort of hanging around. And so we had this what in retrospect appears to be a bubble around 2021, 2022, I believe it was, where a lot of SPACs came to market, but the investments themselves, once they acquired another company, haven't, for the most part, with a few exceptions, haven't panned out very well.
What do you think investors can learn from value investors like Hetty Green or Warren Buffett?
Yeah, so both Hetty Green and Warren Buffett appear in my stories as well. Her story, I call that chapter Hetty Green, the Queen of Value Investing, and it's set in New York City back in 1907. She's not as well known, but was a real trailblazer, and at one point was known as both the world's richest woman and also the greatest miser, which I think really rings true from a value investing perspective. But really, she was a value investor before Ben Graham, who's considered really the first proponent of value investing, and obviously his famous famous disciple, Warren Buffett. She had this real knack of buying things when prices were low and nobody wanted something, and then selling when there was some kind of buying frenzy. And she was able to avoid a bank run. She identified a particular bank that she thought was not on the up and up. She claimed, partly tongue-in-cheek, that the men who ran that bank were too good looking, and that's why she didn't trust them. But it turned out she got her money out before there was a bank run during the panic of 1907. But at the time, New York City was almost going bankrupt, and so she provided some major loans that helped save the city. But in terms of what we can learn from Hetty Green and Warren Buffett and Ben Graham and other value investing, is sometimes it does pay to be a contrarian investor. It's important to have a disciplined approach. There's interesting anecdotes about both Hetty Green and Warren Buffett. They just didn't have this gut feel and say, oh, well, this price is down, so I'm going to buy it. But they did their homework. They did a lot of research. I tell the story of Warren Buffett and American Express. He did a lot of research where he saw this disconnect between what he thought was between Main Street and Wall Street. Wall Street had punished American Express, but he thought Main Street thought that its credit cards, its traveler's checks were pretty solid. So really doing your homework can pay off. Greed can get in the way of sound analysis. As part of the American Express story, Buffett really identified that long-term value can trump short-term profits. Short story is that it looked like American Express was trying to prop up a subsidiary that had got involved in a salad oil scandal when they really didn't have to. They could have just let it loose, but they felt their reputation was at stake. Other shareholders disagreed with Buffett, who was really supportive of what management was doing. And so this was a case of where long-term value can and did trump short-term profits. And the last thing I would say is that it really comes down to a famous saying of Buffett: it pays to be fearful when others are greedy, and greedy when others are fearful. Stocks might be overvalued when everyone wants them, and then undervalued when no one wants them.
Tough for people to do in practice.
Yeah.
Which is why those two are so special, I guess.
Exactly.
Yeah. Okay, so we briefly touched on Charlie Ellis earlier. What are the common threads between winning at tennis and winning at investing? Or I should say not losing, I think, at investing.
So these stories are set around 1975, and we really have two trailblazers here, both best-selling authors. One is Cy Ramo, who was a really fascinating character. I think he past the age of 100. He was the oldest person to get a patent in the U.S. He wrote on many areas. He was instrumental in forming a company that developed some of the first intercontinental missiles, made a lot of money there. But on a quirky topic, he wrote a book called Extraordinary Tennis for Ordinary Players. And what he showed in this book, or what he claimed in this book, is that really there are two different games of tennis. There's the tennis that amateurs like you and I play, and then there's the game of tennis that the professionals play. The professionals play this beautiful game, and they have these long rallies, and they hit the ball in a very precise way after long rallies. They rarely hit into the net, and it's really a whole winning game. You win by being precise and just outdueling your opponent. But that's not the type of tennis that most amateurs play. Most amateurs will hit the ball into the net or hit the ball wide outside of the court. And really, the way that tennis is played by amateurs is you end up losing. And so the point that Ramo was making, if you want to be successful as an ordinary tennis player, then you should play to not lose. And that's the winning strategy is don't try to do these fancy shots. Just try not to lose. Don't try to replicate this game that is played beautifully by the professionals. When Charlie Ellis read this book, he really got inspired and saw the parallels with investing and ended up writing his own bestseller called Winning the Loser's Game. And his key message, and before the book, he wrote a paper in 1975, which really inspired Jack Bogle to come up with the index funds, because the best way to not lose is to try to not outperform, and that's simply buy and hold an index fund. And so really not losing is the key. By trying to replicate what the professionals are doing, that can lead to excessive trading, for example, and excessive trading has been shown to lead to underperformance.